Framework for the preparation and presentation of financial statements. So before starting, what are accounting standards, which type of accounting standards, and studying about it, first we will understand the framework on which this accounting standard is based. What is the purpose? What is the motive when they say accounting standards are there? What they are aiming to? So the framework for the preparation and presentation of financial statement. So when they say accounting standards, that standards are meant for the preparation and presentation of financial statement. So there may be a consistency, a comparability. Like there may be lot of companies who will be preparing accounts. If these standards are not, they will be preparing according to their wish and fantasies and all, and it will be very difficult for the users like lenders who want to invest in that company, or the banks from whom the companies want to borrow. If they want to compare it, it will be not presented in the same form, so it will become difficult for them to understand it. So the standards came into the picture, and when the standards came into the picture, the first underlying assumptions, underlying objectives for the introduction of accounting standards came, so that what is the purpose, what is the aim of the accounting standards we may understand. So we will first understand the framework for the preparation and presentation of financial statements. So when we say this, we should understand for whom we are preparing that financial statements. So the users, there are different types of users like investors, employees, lenders, suppliers and trade creditors, customers, government and their agencies. So as I said, investors, they want to understand whatever the money they have applied, how the business is utilizing, whether really they are making profits, how much risk and how much return, what is the proportion, what is the relationship between it. Employees, how much the business stability and profitability it is. When it comes to lenders, whether they should extend loans to them and whether they will be able to recover interest from it. Suppliers and trade creditors, so that they may understand whether they should have business with that company and whether how much the trade credit period they should extend to it, whether the dues they will be able to settle or not. Customers, to understand the viability of the business. Government, for them to understand what should be the taxation policies, how much the company is contributing to the national income. Public, for the general people, if the company is listed on stock exchange, they are raising the money from the general public through issue of shares. So the public will be interested to understand how much their money is utilized, how it is been applied, and what are the returns they may receive, and how it is better than the other company in the same industry or other industries. Okay, so these are the users, and this is the purpose. This was the purpose of their to understand the financial statements, and that was the reasons accounting standards came into the picture. So when we say financial statements, these are general purpose financial statements which are widely used for the information collected which we get from it is used for the there are huge number of wide range of users of this general purpose financial statements. Here these standards don't cover special purpose financial reports which are specifically prepared for any like taxation purpose, for any other, like if you are doing IPOs, then for that purpose. Okay, so these are general purpose financial statements. And when we say the financial statement, a complete set of financial statement, it includes a balance sheet, a statement of profit and loss, which is also called as income statement, and a cash flow, and notes and other statements and explanatory material that are the integral part of financial statements. So when we say financial statement, it does not include reports by directors, statement by chairman, discussion and analysis by management, and similar items that may be included in the financial or annual report. But it may include segment reportings, all the reports related to the business. Okay. So this is the financial statements So now we spoke about the users. What is the financial statements we understood? The responsibility of the preparation and presentation of financial statements lies on the management of the enterprise. So the management may include other information, their purpose of additional information, this all we need, it's their purpose, but we will be looking only to the users general purpose financial statements, which are being, what are the financial statements and what is included, only to that we will be looking into. So what is the objective of the financial statement? To satisfy the information needs of the people, users. So what is it? They may require the financial position, performance and cash flow of an enterprise that is useful for a wide range of users in making economic decisions. So when they say financial position is the position of that business on that day or at the end of that accounting period. When we say performance, the ability of the company to make profits or profitability, or what is the status, how during the whole period whatever the business they have done, how was their performance, that to analyze. And the cash flows, what are the movement of the cash flows. Okay. So financial position, performance and cash flows. If you see, financial position you get through balance sheet, performance you get from the P&L, and cash flow is the cash flow statement you will be preparing, and notes to accounts are the supplementary information which will be an additional information to all these three. Okay. So these all will always help you to understand the liquidity and solvency of the company. So you will get the definition of liquidity and solvency. I will read out. Liquidity refers to the availability of cash in the near future to meet financial commitments over this period, and solvency refers to the availability of cash over the longer term to meet financial commitments as they fall due. Okay. So these are the information main areas I will be covering, which is something called underlying assumptions. So what do you mean by underlying assumptions? These are the assumptions which are expected to be fulfilled by the company, and to that disclosure is not made in the books, but it is assumed that it is being satisfied by that company or the enterprise. So what are they? There are three: accrual basis, going concern and consistency. So when we say accrual basis, means recording the transactions and other events when they occur and are recorded in the accounting records and reports in the of the periods to which they relate. So when they occur and to the period which they relate, only they are recorded, in which is not same in the cash basis. As we know, the basis of accounting are two types: accrual basis and cash basis. So underlying assumption in this is that when we apply this accounting standards and all, that these books are maintained on the basis of accrual basis of accounting. So accrual basis believes that as and when they occur, irrespective to whether it is received or paid, when the obligation arises, it is been booked in the books to the period to which it relates. Okay. So financial statements prepared on accrual basis inform users not only of past events involving the payment and receipts of cash, but also of obligations to pay cash in the future, of resources that present cash to be received in the future. Okay. So, accrual basis of accounting gives you the clear picture of whatever received receivable of that related period. So, if the company's book of accounts or whatever the notes or whatever the accounting policies they have explained in their report, in that they are silent about accrual basis of accounting, it means they are applying. If these are not been fulfilled, then they have to give a clear explanation, disclosure of non-fulfillment of this basic assumptions. Okay. These are the main basic assumption. So, going concern. Going concern is that it is been assumed that this enterprising is in a good position, which will be working for a foreseeable future, and it will continue its operation for that foreseeable future. Hence, it is assumed that the enterprise has neither the intention nor to need to liquidate or curtail materially the scale of its operation. If such an intention or need exists, the financial statements may have to be prepared on different basis, and if so, the basis used is disclosed. So, if the company is not having any requirement to close down the business or liquidate it or stop the operations, it is in a very good position which can continue its operation for foreseeable future, then it is considered to be a going concern. If it is not a going concern, then separate disclosures required to be made, and books and financial statements has to be prepared according to the need required. So, if the books of accounts are silent about, financial statements are silent about this, it is assumed these accounting assumption is been fulfilled. Consistency. When they say consistency, it means whatever the accounting policies they are following from one period to another, it has been continued every year. There has been no change in accounting policy. If the circumstance require and they require to change accounting policies, they can do it with a separate disclosure regarding same. But it is assumed that once they have adopted an accounting policy, they are fulfilling or they are following the same accounting policy for each period. Any change, a separate disclosure to the extent required, which accounting standard specifies what all disclosures required to be made, has to be made. So, underlying three assumptions are accrual basis, going concern and consistency. And these are that assumptions which are assumed to be followed, and if they are not followed, a separate disclosure required to be made. If they are followed, no disclosure required. If they are not followed, only the disclosure required to be made. Okay. Now, qualitative characteristics of financial statements. Why the financial statements are there? Understandability, relevance, materiality, reliability. Okay. Comparability. So, these are the basic which we will be again discussing in the AS1. So, here mainly to discuss was this much. So, we will be discussing some points again in AS1.